This attempts to put all asset classes on one level playing field, and it's sometimes difficult to do. But basically, you can see on the left side of the program the rates that you earn on government bonds in the United States and Europe and Asia are running somewhere around the 1 to 3% range. If you take away inflation, you're really not making any headway. So not overly attractive in the fixed income arena, particularly as pertains to government bonds. As you move to the right, you can see if you loan money to corporations, you get paid a slightly higher rate throughout the world and throughout the globe, somewhere in the 3.7 to 4% range. But again, if you take away 2.5% inflation, the prospects aren't quite as bright. But again, these are the least risky assets. Over on the right side of the page, I have two other asset classes. One are riskier bonds, as represented by some of the smaller companies here in the United States, represents the yield that one could get if you invested beyond the creme de la creme of corporate fixed income, corporate companies, and lent them money. You can earn somewhere just on the coupon itself, that's the interest, somewhere around 8 to 10%. But of course, there are more risks involved with that sort of investment. And then finally, what I've done, a little bit of cheating, but I've put equities, stocks, on the same plane as fixed income. And I've done the converse of the price-earnings ratio, which is a normal sort of metric on how attractive companies are. I've inverted it so it's the earnings over the price. And so it's the earnings yield to some degree. And you can see, actually, that those are fairly attractive if you look at over a period of time. So the price-earnings ratios of companies are fairly attractive, and our assessment of the attractiveness of equities versus fixed income is indeed higher. So that provides a little bit of the graphical representation of relative attractiveness of asset classes. Just a couple slides on the good, bad, and the ugly. The U.S. economy has really been a bit of a stalwart here, as you know. There were fears that we'd go into a recession last year because of what was going on in Europe, and that actually didn't happen. Data points, while indicating very slow growth here, the growth seems to be reasonably sustainable. There are enough decent things going on, including the consumer deleveraging, to indicate moderate recovery, but nothing to, as they say, write home about. Growth rates are in the 2 to 2.5% range for next year, for 2012. Consumer confidence and business confidence is, again, reasonably moderate levels, but just kind of in the positive territory. You know the story, I think, from the headlines on unemployment and underemployment. Unemployment rate has come down, but it has ticked up here recently, so we've gone from 9.4% down to 8.2%. Government rates are very low, as indicated before. That provides a bit of a boost for economic growth. Inflation is fairly well under control, somewhere in the 2 to 2.25% range. And the last point here is that corporations, companies, have something like $2 trillion in cash. Now, we all wish they'd spend some of that cash to hire. A little bit more of a balance there, I think, would be helpful to economic growth, and a judicious use of that cash will be important going forward. It has meant in the short term that they can withstand the difficulties. But I would tend to agree with you. Give money back to shareholders in terms of dividend increases. Stock buybacks can be beneficial, but begin to hire. And I think that'll happen once there's some modicum of certainty which creeps back into the marketplace. So the bad, briefly, Europe is a mess. If we think that unemployment and underemployment here are difficult situations, know that unemployment is 25% in Spain, and youth unemployment is 50%, and people are on the streets. I don't need to belabor the point on Greece, Italy, and Spain, but they are in significant trouble. We continue to monitor situation. I'll also tell you why Greece, Italy, and Spain do matter to us, and I would expand on that if I had more time. But you know also that there were recent elections that basically threw out the austerity parties. So people are getting tired of belt tightening in places like Greece and France, and this is really something to watch and to see how and if there's a loss of confidence in the ability of governments around the world to deliver against the difficulties that we're experiencing now. I don't think I need to say too much more other than, Europe looks like it's going in recession. I don't know why people aren't talking about depression in places like Greece, because it's certainly, 5 6 years of negative growth and contraction in growth. Again, for the smallest country, but with implications and ripples across the pond, so to speak. And then just to get to where it matters are the difficult shape of banks and financial institutions. Contrasting, I think, with a little bit better situation for banks and financial institutions here in the U.S. Banks in Europe really need to capitalize and raise more capital, which is hard to do in the current environment. So what are we doing about all of this? We were off to a terrific start for the year, up, as Mike alluded to, somewhere in the 12.5% range for the first quarter of the year in terms of equity prices. So it was feeling a lot better, but some of the echoes of 2008, 2010, 2011 have reappeared. In some ways it feels like Groundhog Day. In some ways, one has to remind oneself that history doesn't repeat, but it sure does rhyme. We try to calibrate how far along we are in sort of solving a number of the issues. And the things that we're watching are really what happens to U.S. growth. Can we sustain some level of U.S. growth? And it looked like we were on the path to doing that, and recent numbers have, we decided that this wasn't a great analogy, but 3 yards in a cloud of dust or something like that, or 3 steps forward and 2 steps back in terms of the economy. We seem to have fallen off a little bit with the most recent employment numbers, and this is a result of uncertainty. Secondly, obviously watching what's going on internationally. I alluded to this distrust in government. What are the policies which will be put into place? And third, kind of the third leg of the stool, is the growth in what had been the fastest areas of the global economic scene, meaning China and other emerging markets, which have been growing at somewhere around 9%, slowing down to 7%. Be a good problem to have, but of course, folks are concerned that growth goes from 9 to 7 to 5. And it's very difficult to get data in China. You'll be amused by this to some degree, that the way in which you calibrate economic growth is looking at electricity consumption. And electricity consumption has been running around 3.7%, so worth watching. We're more optimistic, I think, but opportunistic.